Have you ever wondered who owns the world's debt? If we add it all up, the United States owes over $38 trillion. The European Union, 14 trillion. Japan, over 9 trillion. It seems like a never-ending spiral of numbers, a planetary scale IOU. But here's the paradox. Who does the world owe this money to? The strange, simple answer is itself. We live in a global financial system where one nation's debt is another's asset. It's a complex web of promises, a system built not on gold or tangible goods, but on something far more powerful and far more fragile: trust. This entire system wasn't born overnight. It's a story that begins not in a sterile data center, but in the flickering candlelight of 17th century England. Imagine King William III, embroiled in a costly war against France. Wars are expensive, and the crown was broke. So a revolutionary idea was born. A group of wealthy merchants came forward with a proposition. They would lend the king £1.2 million at 8% interest. In return, they would receive a royal charter to establish a new entity, the Bank of England. This wasn't just a loan. It was the birth of national debt as we know it. The king got his money for the war, and the merchants received a guaranteed stream of income, backed by the full faith and credit of the government. For the first time, a nation's debt was transformed into a secure, tradable asset. It was a financial innovation that would change the world forever. This English experiment quickly spread. The Dutch masters of finance had already been experimenting with similar concepts. France followed suit, and soon the idea of government bonds crossed the Atlantic to a fledgling United States. Governments discovered they could fund everything from infrastructure to military campaigns not just through taxes, but by borrowing from their own citizens and from others. The very concept of a government's promise became a form of currency. Ships carried these paper promises across oceans, printing presses churned them out, and early stock markets began trading in the future of nations. The age of sovereign debt had begun. The battlefield was slowly but surely becoming the balance sheet. Fast forward to today. The principles are the same, but the scale is staggering. The quiet halls of the Bank of England have been replaced by the frantic energy of Wall Street, the neon glow of Tokyo, and the digital pulse of the Shanghai Stock Exchange. Trillions of dollars in government bonds are traded every single day. These aren't just numbers on a screen. They represent the bedrock of our modern financial system. When a government like the United States needs to spend more than it collects in taxes, it issues treasury bonds. Think of them as IOUs, sold to the highest bidder. So who buys these IOUs? You might be surprised. A huge portion is held by domestic institutions. Banks buy them as a safe place to park their cash. Your pension fund likely holds them to ensure it can pay you in retirement. Even the Social Security Trust Fund is invested in them. But a significant chunk is also held abroad. Countries like Japan and China are major holders of U.S. debt. Why? Because the U.S. dollar is the world's primary reserve currency, making its debt one of the safest investments on the planet. It's a self-reinforcing cycle. The world trusts the U.S. to pay its debts, so it continues to lend it money, which in turn reinforces that trust. It's a delicate, circular dance where everyone is both a lender and a borrower. Imagine the leaders of the world's largest economies sitting around a high-stakes poker table. The chips aren't plastic. They're labeled IOU. China pushes a stack to the United States in exchange for manufactured goods. The U.S. then slides some chips to Japan to pay for technology. Europe trades IOUs amongst its members to stabilize its currency. It's a global game where the objective isn't necessarily to cash out and go home, but to keep the game going. As long as everyone believes the chips have value, the game continues. The moment one major player doubts the value of another's chips, the entire table risks collapsing. And sometimes it does. We've seen the cracks appear. Remember the Greek debt crisis? Riots in the streets of Athens as the government imposed severe austerity to satisfy its creditors. We saw Argentina default on its debt multiple times, plunging its economy into chaos. More recently, Sri Lanka, unable to pay for essential imports, descended into protests and political upheaval. These moments are brutal reminders that behind the abstract numbers are real people, real lives, and real consequences. When faith in the IOU falters, the system reveals its unforgiving side. It's a precarious balance, a tightrope walk between growth and collapse. So how does this system sustain itself? The secret is that debt is rarely paid off. It's refinanced. When a government's old bonds come due, it simply issues new bonds to pay off the old ones. It's like paying off one credit card with another. The system resembles a shark. It must constantly keep moving forward, constantly growing to survive. New debt must be created to service the old. As long as the global economy grows, there's enough new money to keep the gears turning. But if that growth stalls, the gears begin to grind. The entire structure relies on a perpetual state of forward motion. We often hear politicians talk about balancing the budget and paying down the national debt. They stand at podiums, making grand promises of fiscal responsibility. Yet, if you look at the charts, the line almost always goes in one direction, up. Why the disconnect? Because a sudden drastic reduction in debt would mean massive cuts to government spending, huge tax increases, or both. It could trigger a deep recession, shrinking the very economy needed to pay the debt in the first place. The rhetoric is for the public, but the reality for policymakers is that the debt machine is too big and too important to simply switch off. Ultimately, what is this colossal mountain of debt? At its core, it is a mechanism for transfer. It transfers spending power from the future to the present, and it transfers wealth from one group to another. When a government issues bonds, it is often the workers, the factories, the everyday producers of goods and services whose future tax dollars will be used to pay the interest. And who receives that interest? The investors, the pension funds, the banks, the wealthy individuals who bought the bonds. It is a slow, silent, and continuous transfer of wealth from the broad base of the economy to the holders of capital. Look around. From the wealthiest investor in a Manhattan skyscraper to a factory worker in Shenzhen, from a farmer in Kenya to a student in Brazil, we are all connected by these invisible lines of credit and debt. Our global system isn't built on gold bars in a vault. It's built on a collective belief, a shared story about the value of a promise. The most startling truth may be this: debt isn't meant to be paid back, it's meant to be believed in. Thank you for joining us on this journey through the world of debt. If you found this thought-provoking, please consider liking this video and subscribing to our channel for more deep dives into the systems that shape our world. See you next time.